So, welcome to the Tax Talk podcast, an exciting series with Dan Anders. Dan is a certified financial planner and a fellow trust and estate practitioner through STEP Canada. After tragically losing his father in a fatal car accident at age 10, it is notable that Dan decided upon a career in the insurance and estate planning industry at age 25. He saw firsthand the struggles that inadequate planning can cause the family that is left behind. Dan now goes above and beyond to tailor insurance solutions that match your unique needs and goals. He believes in the power of personalized service and building lasting relationships based on trust and exceeding your expectations. So, Dan, just want to say thank you for taking some time out of your busy schedule to hop on the podcast with me.
Thank you, Jared. Really enjoying this summer.
For sure. It has been some nice warm weather out here in Alberta, and I hope the same for you out in BC.
It's been beautiful. It's a great place to live in from May till October for sure.
Fair enough. So today, the title of the episode is Better Mortgage Insurance Protection. So we're just going to hop into it. I got a whole pile of questions here that I want to run through with Dan. So we're just going to jump into the first one. So I just want to kind of touch on some of your credentials so people kind of get a bit of a knowledge of your background, what it is that you do. So first up, what does a certified financial planner do for their clients?
I was trying to give, really concise thought to that, and without going into a really lengthy explanation, I really believe that a certified financial planner helps people provide a roadmap for their why or whys in life. So that's what I think financial planning should be doing, is providing perspective for people to achieve their goals and how best to do that.
Perfect. No, that's a great point. And I just kind of got finished recording a podcast episode recently, talking with a business coach, and we were kind of delving into that why aspect. And I think it's important for, families and business owners to have a real good understanding of that why, and then bringing on the applicable professionals to help them kind of guide themselves to ultimately finding out where that why is and getting there in the most efficient and effective way possible.
In all the years I've been doing this, I can tell you there are no two plans that are identical.
That is a very good point. And if you are, hopping into an office with a financial planner and it seems cookie cutter, then maybe it is time to reach out to Dan and get something that is a little bit more tailored for your personal situation.
Thank you.
Perfect. So up next, and this one kind of, we have a bit of familiarity here. So what is a trust and estate practitioner? We both hold this designation. What is it that you tell clients that you are able to provide them based on your education through this?
So a member in the Society of Trust and Estate Practitioners is a financial services professional who has expertise in estate planning and all of the components of estate planning for individuals, for business owners, including trusts, family trusts, testamentary trusts, will planning, business succession planning, etc. So the other interesting thing about the TEP designation is the wealth of resources that we have in each other through our STEP Canada community. So, yeah.
Well said, for sure. And I guess when I typically speak with clients, they kind of look at my business card or whatever the case might be. They ask me what that designation means, I guess, in my role as an accountant. And I kind of say, as a CPA, CGA, maybe that's more on the compliance side of things and getting the financials out. Whereas that TEP, I like to think of that as my kind of way of helping business owners and families, really delve into that family planning aspect of things, seeing their businesses transition from generation to generation, and just really being able to focus on that aspect of things. So,
exactly.
Perfect. So, kind of delving into more of these insurance-based questions. So you're going to have to guide me along. This is definitely not my forte. So what is mortgage insurance and why is it required in Canada?
It's a really good question, and I think the question and the answer is a good indicator of why people tend to be so confused about the topic of insurance.
Hmm.
And so, in some of my intellectual material that I publish, I say, there's mortgage insurance and there's mortgage insurance.
Right.
What's the difference, right? So when we're buying a piece of property and we have less than 20% down on that piece of property, Canadian Mortgage and Housing Corporation determines that we have to buy mortgage insurance. And it's interesting insurance because the buyer is paying for it to protect the lender.
Mm.
And it's required to have if you have less than 20% down payment.
Right.
And they calculate the premium based on how much you are short in between that 0 down and 20% down, and then they add it to your mortgage. So you're actually not only paying the premium for that, you're paying the interest on the amortized mortgage that you have, which is kind of crazy, but it's one of those things where the people who create the rules get to dictate the rules. Now, what the real mortgage insurance genius does is recognize that once a person purchases a piece of property, whether it's their residential property or if you're a business owner, you buy a commercial building, or if you're a farm agricultural contributor to our economy, mortgage on your farm. Most people are concerned that if they die, become disabled, or become critically ill, that they want the mortgage dealt with or funded to be dealt with by the beneficiaries of their policy. So the type of mortgage insurance that I specialize in is the latter. It is the insurance that a person buys to protect the investment they've made so that their family can continue to reside in that home, or the business can reside in that business, or the farm family can reside on that farm, even if the insured person passes.
Gotcha. So I guess while it's probably maybe not set up in the greatest way, it probably is a bit of a necessary evil to, I guess, protect families, business owners, et cetera, in the event that someone passes away, probably most notably in a time that was not expected, and you're throwing that family for a bit of a loop. So I guess there's probably some pros and cons to it, and I guess we'll probably get into maybe how you can structure that life insurance in a better manner to, get the same benefits, but maybe not have some of those same downsides that you kind of mentioned there earlier.
Exactly.
Right on. So how does mortgage insurance work in Canada? What are the eligibility criteria on that?
So this is at the really the essence of what we do at the Real Mortgage Insurance Genius, and that is, excuse me, the lending industry. The typically in Canada, the banking industry, Canadians love their banks, and the chartered banks have a built-in creditor insurance that they market as mortgage life insurance, mortgage disability insurance, mortgage critical illness insurance. That particular insurance in almost all cases is overpriced, under-designed, and not portable if you move your mortgage later on. In addition to that, if you have any health problems or health issues, it's very easy to get kicked out from that insurance, the creditor insurance. And last but not least, because the creditor insurance is sold to you by somebody who isn't insurance licensed, whether that be, the bank personnel, or whether that be, a professional mortgage insurance broker whom we do a lot of business with. The fact of the matter is they're not insurance licensed. They don't really have a good grasp of what it is that they're recommending. And chances are they have one size fits all solution. Whereas when you're dealing with an independent insurance professional like us, we have access to dozens of insurance companies across Canada and can design a solution for you that is more cost efficient, much better plan design, portable if you move your mortgage. And perhaps the most important thing is you don't have to worry about post-claim underwriting. There was a tremendous documentary done on CBC Marketplace in 2007. It's still on YouTube. It's called In Denial. and it talks about the cracks in the pot, if you will, of the creditor mortgage insurance industry. I really strongly recommend anybody look it up. It's called In Denial. It's on YouTube, and it talks about creditor insurance and what a poor choice it is.
So that's an interesting point. I didn't know that the individuals selling these particular policies are not necessarily well versed or qualified to be selling them. So I guess from a consumer standpoint, it's probably tough to go into that situation knowing that you're getting a good product if the person that is advising you on it doesn't really have any expertise in that. So that is a little scary, I guess, to hear that
Well,
for sure.
it would be the equivalent of somebody going to their bank and asking them for accounting and tax advice.
Right.
They're not a CPA. They're not even booked resembling, adequate tax advice.
Right.
It befuddles me how anybody could think that that's the thing. So insurance is a very highly specialized industry and field, as is accounting, as is
Mhm.
estate planning. So the reality is, if you want to get the best ultimate coverage, you should deal with an independent professional in that regard, I believe.
Yeah, that makes sense to me because, like you say, there are different levels of so-called accountants out there. You can go to the mom and pop bookkeeping shop and they can put
Yeah.
together a corporate tax return for you, but are you getting the same level of expertise getting that return done versus coming into, our firm? Are you getting the same level of expertise talking to, Joe Blow banker versus going in talking to Dan and getting a specialized plan that deals with your specific needs? I think it's probably pretty obvious which road would probably be best for you and your family going forward. So good point.
Yeah, exactly. Yeah.
Right on. So how is the cost of mortgage insurance in Canada determined?
It's determined by our gender, our smoking status, and our age.
Okay.
As simple as that. And then you could add in health. In
Okay.
some cases, if you've got extenuating health circumstances, you may have to pay slightly more to get your coverage.
Hmm.
So that would be the fourth indicator. That's a
Interesting.
very competitive marketplace. One thing I will say is that insurers are aware of the competitive pressures.
Right.
And if they can offer you a better price than the standard middle of the road price, they will offer it to you because they want to keep your business. It's not like they're going to keep it from you and say, oh, Jared is an excellent specimen of health. He's practically an Olympic athlete. He would qualify for preferred plus rates, but we're not going to tell him because we can make more money if he just takes the standard rates. Insurance companies aren't like that. Trust me. They know there's competitive pressure, and if you qualify, for better than regular rates, they're definitely going to offer it to you.
That's a good point. Good to know that. So I guess it's probably wise then to understand that maybe if you have a policy put into place, to maybe keep that in mind, if it has to come up for renewal, that you're maybe shopping these things around and you're not just locking in with one company for the long term. There probably are some good options out there and lots of competition to buy up your business at a decent rate then.
Yes, exactly. Yep.
Perfect. Um, so I guess this will probably maybe transition into some questions that'll maybe more focus on the mortgage genius aspect of your
Sure.
business. So can a mortgage policy be transferred or ported to a new property?
Okay. Also a good question. If you get the creditor insurance from the lender, let's say the bank in this case, and you keep your mortgage with them and then buy a new property, yes, you can port the creditor insurance to the new property.
Okay.
But if you have a more competitive offer to go elsewhere, you cannot port that creditor insurance. If you have individual custom designed insurance for your unique circumstances, you own it, you control it, you're paying for it,
Right.
you take it with you wherever you go. So it's if you want to be in control, you should have your own coverage and forego the offer to have the creditor insurance that the bank may offer you.
Right. And it would make sense to give yourself as much flexibility as you possibly can. You know, I presume when you get into that initial mortgage with whatever bank it is, maybe that policy works at that time, but maybe a couple of years down the road, you need to sell that house and you need to transition. Maybe that bank isn't offering the best rates as far as interest goes. Maybe you've got some other options at that point in time, but then, you're left kind of holding the bag. Do I stick with this same bank to keep the policy ported? Do I, drop it and get some better interest rates? So yeah, if you've got this unique plan put together with Dan, then you've got the options to be a bit more flexible when you need to move that property down the road. So
Yeah, I think a simple rule of thumb that I've discovered is that up to about the age of 40, the
mm,
cost of creditor insurance is the same as buying it independently.
oh, okay.
But the policy design is not. There's a whole bevy of policy design deficiencies in the creditor insurance that you would overcome by having personal insurance. Now, when you get above age 40 and age 50, and in some cases age 60, I've had insurance quotes where I've been able to save people 2/3 of what they were paying in premiums to their banks, and they're in their 50s. So the reality is, the older you get, the more important it is to try to get your own coverage as opposed to the creditor insurance. Yeah, so it's like I say, and there's we have a on our website and on our social media pages, we have a link to an ebook guide that deals with all these issues more specifically. But we're we have the ability. I think right now, Jared, what's really important, as we know, in the financial services world, the interest rates have climbed dramatically. And I'm doing financial plans for people right now. I had a young couple from Victoria last week, and then again this week we presented their financial plan to them, and they're renewing their mortgage in December of this year.
Mm,
Yeah, their current rate on their mortgage is 2.89%.
yeah.
And speaking with a friend of mine who's a professional mortgage broker, just a wonderful guy, really, really ethical. And he looked at it and he said, the best that they can hope for is in between 5 and 6%.
Right.
And that means their mortgage payment is going to go from $2,700 a month to almost $4,400 a month. That's
Yeah.
kind of what they did. That's kind of what they did. So, if you can save money on your insurance, however little those savings may be, every bit helps. When you're in a situation like we're in right now in Canada, where the interest rates are so high, and as you and I well know, lots of financial projections about mortgages renewing this year, 2024, 2025. This is creating a kind of a mortgage Armageddon for Canadians. And yeah, it's so anything that we can do to help people reduce expenses.
Nope. Sorry, it looks like you cut out there for a quick second.
No problem.
So yeah, no, that's a good point, Dan. Like you say, with the markets and interest rates being so volatile right now, if you can probably reach out now to start doing a bit of this planning as opposed to maybe waiting till that mortgage comes up for renewal. Like you said, anything that you can do to maybe save some dollars is going to be a wise move because yeah, just that, you know, couple points in difference there in the interest rate obviously translates into significant changes in that monthly payment. And, you know, it's not going to be possible for a lot of folks to make up the gap on some of these mortgages, I'm guessing, when they come up for renewal. So yeah, it's kind of a perfect storm where we had, fairly high property values with historically low interest rates, everybody, flocking out of the cities to go buy these bigger houses. And yeah, like you say, in a few years here, when things come up for renewal, it's going to be probably pretty tough for a lot of people. So taking those steps to save any dollars where you can is probably going to be in your best interest for sure.
Yes.
So I guess we maybe kind of chatted about this a bit, but maybe we'll dive into it a bit more detail. So can a mortgage insurance policy that I got, with my banker, can that be canceled or terminated before that loan is paid off? So say I'm locked in, I don't like this insurance. I want to reach out to you. Can I cancel this old policy, put in something that is a little bit more flexible for my needs going forward?
Yeah, this is a question that comes up a lot in a lot of different scenarios. And here's the Coles notes on insurance policies in Canada. Every insurance policy in Canada can be canceled within 30 days,
Hmm.
no matter what. No matter what. No, there is no such thing as I'm locked in for, until my next annual renewal, or I'm locked in for 5 years, 10 years, 20 years. Every insurance policy in Canada, whether it's on your car, your home, your business, your life, whatever, can be
Right.
canceled within 30 days.
Interesting.
But don't cancel it until you have something better.
Probably an obvious statement, but a good one
Yeah.
to mention nonetheless. Don't
Yeah.
forego one policy and then something happens and you're out of luck there with no coverage at all. So
Yeah.
better to have the poor policy than no policy at all, I guess.
Yeah, my aging Danish mother came over from the old country, of course, back when European immigration was settling Canada.
Mhm.
And she always said, so I think that applies here. Don't get rid of something you have until you know you can get something better.
Right. Yeah, no, that's a good point. So, and I guess this ties into the next one fairly well. What happens then if a borrower defaults on their mortgage, but they still have that mortgage insurance policy in place?
So if the mortgage insurance policy is one that they bought from the bank, that also defaults with the mortgage.
Hmm.
But if they buy it individually, that because they have separated their mortgage from their insurance, they can continue, paying for and keeping their insurance policy and carry it with them. It's ultimately portable.
Right.
That's the big key.
Interesting. So yeah, I guess it gives you that flexibility going forward. If something should happen, then you've got options to kind of deal with that policy in a manner that you choose and that works best
Correct.
for your family.
Yep.
Okay. No, that's a good point for sure. So yeah, I guess at the end of the day, we're just kind of keep harping on this, get this policy in your own name, own it, and you've got options in a wide variety of circumstances to better fit your needs as opposed
Correct.
to just paying the bank what they're looking for and kind of being limited as far as what you're able to do with that policy then. So
Yep.
perfect. Um, So next question, discussing kind of the creditor insurance. What does it mean, I guess, when you speak portable? So, if we have that policy through the bank, I presume as you're making payments, does that impact the policy at all versus, when you've got that policy in your own name? Is there a bit of a difference kind of in the portability, the payments, that type of thing?
Yeah, 100% difference. If you own your own coverage, you can move your mortgage.
Good.
If you own the creditor insurance and say maybe when you bought it, you were healthy and insurable, but you no longer are.
Right.
You have to consider, if you want to have your mortgage insured, you have to consider leaving the mortgage with that lender if you're not
Mm.
insurable. So again, something you should look into before making changes and looking for new mortgages. If I want to insure my mortgage for my family's health and well-being, can I qualify for insurance at the new lending institution, or even buying it independently, which of course is fairly obvious I'm recommending.
Right. Okay. So yeah, I guess in conjunction just to being able to move that policy, it's also delving into that health aspect and having that knowledge that, maybe having that policy in place that's, directly tied to you is going to benefit you long term because it might alleviate some of the concerns of renewals and having to deal with those health insurance questions again. So,
Yeah, I think it is every bit as important as when or where you're going to renew your mortgage. I mean, if you're with an existing lender and your mortgage is coming up for renewal, that existing lender pretty much has to renew your mortgage if it's performing.
right,
You do
right,
not have to requalify.
right.
If their interest rates or their package or their service or something about that relationship doesn't, suit you, if you have to qualify for your mortgage again, now you have to qualify for it at 7.5%, even if the borrowing rate is 5.5.
Mm,
So you got to be really careful, and this is why I always recommend that to have a relationship with independent professionals like accountants and insurance agents and mortgage brokers is really imperative, quite frankly, because you can look after all of these questions, concerns, and comments that you do have to take into consideration. You've got to be careful to make sure that you do it right so that you don't get hit with a very unpleasant surprise or outcome.
for sure. And I don't know, maybe speaking from my personal experience, and I appreciate that comment on, developing those relationships with professionals. I've personally found it hard to develop those relationships with bankers. I find that industry just tends to turn over quite a bit. And,
Exactly.
the individual that you might have seen to go set up that account or that policy or whatever the case, one month you phone back in a few months and they've moved into a different role or a different branch or whatever the case might be. And I think if we're talking, life insurance on, what is probably the biggest asset that most people have in their lifetime, you would think you would want to have as solid of a relationship as possible in place to deal with that policy. If something needs to change on it, if the worst ultimately ends up happening and your family needs to make use of the policy to pay down the mortgage, etc. I think you would want to be able to reach out to this individual and be in contact with them on a regular basis to ensure you're not kind of left hanging, holding the bag if something happens. So,
Yeah, I think the last thing, if the worst happens, the last thing that any family needs at that moment in time is financial pressure on top of all the emotional loss.
for sure.
I recall back very early in my career, we had a fellow out. He was a keynote speaker at a conference for the insurance industry when I was living in Calgary.
Hmm.
And, he said from the stage, is something that's always stayed with me. He says, when somebody dies, everybody's sorry.
Hmm.
The family is sorry, the brothers are sorry, the sisters are sorry, the parents are sorry, the neighbors are sorry, the priest or pastor is sorry, the friends are sorry. I'm sorry too, but I'm the only one who's showing up with a check. And that's reality. I mean, insurance is not an easy topic for most people to deal with. That's why we have insurance professionals in Canada.
Right. Yeah, and I think it's important to, like you say, even though it's not an easy topic to maybe discuss, it's very important because you don't want to get down the road where something does happen and then, you've got this additional financial pressure on the family. I think most people, upon passing, they want to be able to, leave some sort of legacy to their family, let them be able to, grieve appropriately and not have to worry about, is there insurance? Are we going to get, punted out of the house because things aren't set up correctly? It would be just a lot easier, mom or dad passes, we reach out to Dan clears up the policy, we pay off the mortgage and we kind of go about our business. We're able to, grieve the loss of the parent or whatever the case is. So I think that's an important thing to note for sure.
Yeah, the other key difference between the creditor insurance and your individual insurance is that the creditor insurance pays down the mortgage. You don't have any say in the matter. In other
Right.
words, it protected the lender again,
Mhm.
right? You may be in a position where you get a payout on the insurance policy to you if you own your insurance individually, and you say, we're just gonna right now we just want to hold on. We want to put the money in the bank or the credit union,
Mhm.
have it sit there for a while we figure this all out.
Right.
In the meantime, we can continue to service the mortgage, and
Right.
then ultimately we may decide to pay down all or some of it, but
Right.
we have control of that money. Whereas if you buy it through the creditor, the bank, the lender, you don't have that option. They take
Right.
that option away from you, and yet you paid for
Right. 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 Right.
it, right? So,
Yeah, and it would be my understanding too, if you have that policy through the creditor, as that mortgage pays down, you're
yes, sir.
effectively reducing the coverage that you have. Whereas if I was
Right,
to take out a policy directly through Dan, I say at the time my mortgage is whatever, 250 grand, let's say. Well, I want to ensure that I have, let's say, at least a $250,000 policy. But as
right,
keep paying that mortgage down, that life insurance through Dan stays at 250K,
right.
whereas through the creditor, my kind of ending life insurance pot is just slowly depleting as time goes on. So you keep making the premiums at the same rate, but the
Correct.
coverage and the ultimate payout on that, is very different between one provider and another.
Yeah, and I should note that if you want to buy decreasing term insurance on an individual basis, that is available.
Oh, okay,
And it will save you a few dollars in premiums and everything. So
sure,
in some cases, a person's financial plan would indicate that decreasing term insurance isn't the wrong solution. In fact,
okay,
it's probably the best bet.
right,
But you're right in saying that the majority of insurance policies term policies do stay at that level coverage,
right.
and the premiums stay at that level coverage. So there is that excess there if you die, 9 or 14 years into paying your mortgage down.
Okay.
Yeah.
So I guess just for my own personal interest, so with that decreasing policy, would you kind of see that in a situation, say, you've got a family, say the husband's working full time, maybe he has, a permanent policy on himself. Maybe the wife is stay-at-home mom. Would it make
Yeah.
sense then to kind of have that decreasing policy on her that's kind of timed in conjunction with the mortgage? So if she happened to pass prior to that mortgage, being fully paid, you've got some coverage there, but you're maybe not paying over and above because maybe the husband is the kind of the main breadwinner. Is that kind of a situation where you'd see something like that set up?
It may be, let's say that you have a successful farm or a successful business,
Right.
and that successful farm or business is going to continue generating revenue even if the key person passes away or becomes disabled or critically ill.
Okay.
So they've got an asset that's producing revenue.
Right.
So in that particular case, it may be that just paying off the decreasing amount of the mortgage is it fits in well with their unique financial plan. I think
Right.
primarily the reason for decreasing term is simply to reduce your premiums a little bit.
Okay.
It's not, it's certainly not the most often recommended nor purchased type of insurance in Canada, but it is available on an individual basis.
And again, it boils back to the factor that reaching out to Dan's going to be able to put together, this holistic plan that
Yeah.
delves into all the areas that, you might be involved with, whether it's a business, etc., and fully understanding all of these pieces as they come together. Whereas, you get this decreasing term insurance from that creditor, maybe it's
Yeah.
not what you're looking for at all, and you're paying for something that doesn't work for your family situation at all.
And it can be as easy as just saying, I've got everything, I'm in control of everything. I know what I'm doing. Everything's okay. All I need is the best rate and the best plan design, the best coverage for my mortgage. Fine, we can do that quite easily.
Right.
If you would like to have additional financial planning and perspective added, we can do that too. So
Perfect.
it can be really easy, and it
Right.
can be chock full of holistic planning advice and reviews as well. So
Perfect. Right on.
Yeah.
So we've kind of delved into a bunch of the benefits
Yeah.
that would come with these types of insurance policies. Anything else that a family might consider in, reaching out to you as opposed to maybe just grabbing this creditor protection that comes with the mortgage?
I think that your last question, aside from insurance solutions, what other expert guidance are you able to provide? Well, of course, we do insurance planning. We also do estate planning. We also do retirement planning. So the thing that I'd like to say is just I really do believe that people can do themselves a favor by separating their lending from their insurance.
Hmm.
Do them both independent of each other, because you'll come out ahead. It might be a smidgen more complicated, but it's going to be well worth your time invested to do it that way.
Sure. No, that's a good point. So yeah, I think, whether you want to reach out to Dan locally or you've got someone else in your area that you've, thought
Yeah.
about, I think it makes sense to definitely touch base with that individual provider. And Dan, are you kind of able to provide services outside of BC? Is that correct?
Yeah, right now we're licensed in BC, Alberta, Northwest Territories, and as business grows and becomes larger, we're probably going to add Saskatchewan, Manitoba, and ultimately Ontario.
Okay, perfect. So yeah, lots of options there to reach out to Dan if you want to delve into any of those kind of areas that he specializes in to get some of that personalized advice that is going to help you and your family kind of preserve and protect your legacy.
And as a native Albertan, a Calgarian, don't hold that against me.
No worries.
I really understand Alberta, and I understand Albertans, and I've still got that in me.
Perfect.
2/3 of my life was lived in Alberta, born and raised there. So I understand Alberta and I understand Albertans.
Right on. Good to hear. So this one is specific to kind of what you do as the real mortgage insurance genius. So how are you able to provide me with some access to unbeatable savings in this process?
So you have my LinkedIn profile. So
I do.
that can be posted along with this podcast if you like. Outside of that, I realize it's a mouthful. The real mortgage insurance genius.ca. You can go there. We also have on Facebook the real mortgage insurance genius. So you have three ways that you can reach out and contact me, or even just pick up the phone, give me a call. Do you have my number, Jared? I'm definitely available for consults, and the footer of my email has links to book 15, 30, 45-minute discussions, whatever you like.
Okay, perfect.
Yeah.
Right on. So you touched on this a little bit earlier. What is the post-claim underwriting process,
Yes.
and
That's
how
really,
how does that kind of impact me? Is there potential traps kind of involved with that?
yeah, you have to think about it from this perspective. If you're buying insurance from your bank when you get your mortgage, you're buying from somebody who doesn't even have an insurance license.
Hmm.
Somehow the Bank Act allows the banks to sell creditor insurance on their loans that they extend to customers. Okay.
Okay.
So if you buy mortgage insurance through your bank, most banks have about 7 questions they ask. And if you answer no to all those questions, you're approved. If you answer yes, you're kicked out. West to even 1 question, you're kicked out. You're on your own. You're on a deserted isle. Okay. That's when you need a professional insurance agent to help you out.
Gotcha.
But if you were buying something of that complexity and that importance, and there was only 7 questions that you had answers to, if you die before your time, or in an unexpected fashion, the creditor insurance is going to go back and double check. And as the documentary on CBC Marketplace, In Denial, on YouTube pointed out, there are more than a handful of cases that are declined for payouts. So you want to make sure that your coverage, all of the underwriting is done up front, because when that insurance company issues a policy, Jared,
Mhm.
Only you, the customer, can cancel it. The only way they can cancel it is if you stop paying premiums, or it's revealed that your answers to the medical questions are fraudulent or were fraudulent, and then even only the first 2 years. So the reality is, post-claim underwriting is a concern. You want to be sure that when you're buying something and paying for it, that when that time comes, um, you don't want to have any second guessing and questions. This is really important in the life insurance business, but equally important for disability insurance and critical illness insurance.
Gotcha. So yeah, I think that's a good point to, again, probably boil back to who you're getting this policy through. Are you getting it through Joe Blow Banker, who
Yeah.
is ticking off his 7 boxes and getting that policy pushed through? I don't know. Maybe he gets some sort of commission on that, and he's just wanting to
Yes.
get the policy out the door and a done deal. Or are you kind of going through and making sure you're getting the policy that is right for you, all the correct paperwork's done ahead of time, and you can kind of sleep easy knowing if something should ultimately happen to you, unfortunately, that your family's going to be covered as a result of having that proper plan and policy put into place.
Yeah, I think you brought something up at the beginning of this podcast interview today. Talk about compliance,
Hmm.
and as you well know, there's long been a concern in the Canadian financial services landscape about what's called tied selling.
Hmm.
So if your bank loans officer says that you absolutely have to have their creditor insurance,
Hmm.
that's tied selling, and technically speaking, it's not legal.
Interesting.
Yeah, it is interesting because the bank managers, the branch managers, and everything, of course, and their staff are their KPIs, their key performance indicators. How much product they sell goes into their performance reviews. So, so it's kind of one of these inconsistencies in our world today. It's not unique to the Canadian banking
No.
system. It's all over the world. The reality is you want to avoid what we know to be in our financial services industry of tied selling. This would be like someone coming to you for tax advice, personal or corporate tax returns, and you tell them, well, you got to buy our loan protection insurance through our firm to protect your loans that we're giving you advice on. I mean, or you've got to buy custodial services from us, trust services from us. And it's bizarre when you think about it that it's permitted, but it is. It's really an interesting aspect of the Canadian financial services landscape.
Yeah, that is kind of a weird point. Maybe it's because maybe as a society as a whole, maybe we kind of integrate some of these things, wealth
Yeah,
planning. I guess you've got your investments and your insurance. They kind of just tie together, I guess, for, you know, everyday conversation speak. So maybe that's kind of why they have gone down this road. But I would agree with you. I mean, you know, you're coming to me for a specific reason, you're going to Dan for a specific reason. You're not buying something outside of the realm of the specific services that we provide. So,
correct.
same should apply to, getting that insurance policy. You're not going to your lender to pick that policy up. You're going to an insurance
Yeah,
specialist.
I mean,
Get that
you've got to understand when you're dealing with a loans officer at a bank, you're dealing with an employee of the bank.
right.
And they have somebody, standing over their shoulder saying, how are you performing today?
Right.
So it's not really on them. It's the machine above them that's, kind of dictating what they need to do in order to keep their performance reviews adequate
Right.
or exceptional or failing,
Right. Right.
right? So it's it takes a little bit of a spine to say thank you very much for the offer. We have a relationship with an independent financial professional, and we're going to check with them first. We may come back and take you up on your offer.
Sure.
Uh, just give us the details so that we know what we have as an option.
Right.
You know, And in very rare cases, creditor insurance might be the best coverage you can get.
Right.
I'm not going to throw it all out. There may be some cases when it works well, and we'd be happy to tell you whether or not what you have already is good, great, and terrific. No need to change it. My only regret is that I wasn't there when you bought it. But it's so like I say, it's a buyer beware, right? Buyer beware.
For sure. And I think I could appreciate that if, you as that expert, you're willing to kind of have a look at that policy and, if it is for whatever reason, suitable for this particular circumstance, there's no need to go burn the policy to the ground and start over. If you, for whatever reason, have some good coverage there that meets your needs, then, Dad can review that and kind of advise you on that. And, probably good to have that second set of eyes look at it and kind of verify that for you. But, in the same light that the bank is trying to meet a quota, well, maybe Dan's not trying to meet a quota. He's trying to make sure that, you've got the best policy in place for what it is that you're needing out of that policy. So that's good.
Correct.
Perfect. So I think we may have kind of touched on this one as well, but maybe we'll just flush it out a little bit more. So what is level coverage in respect of a mortgage balance?
Okay. So, we know that as we have a mortgage, as long as we're paying a higher payment than just interest,
Mhm.
the principal on that mortgage is reducing.
Right.
So if you have creditor insurance, your coverage is also reducing.
Mm.
Whereas if you buy individual personal coverage, and I'm willing to bet in most cases you can buy it for equal to or less than the creditor insurance is going to cost you.
Right.
That coverage remains level while your balance decreases. So you've always got a kind of a buffer zone between here and here of how that extra money could be used to help the family or the business, get through some tough times. Like I say, particularly when a main breadwinner passes, or in many cases, even the spouse who looks after everything in the home, you got a main breadwinner who's working maybe 8, 10, 12, 14 hours. Maybe they work away from home. All of a sudden, their world is thrown into chaos because now they have to do both jobs that, two spouses used to do together.
Sure.
Right. So it's pretty important to get it right.
Definitely.
Yeah.
Yeah. And I honestly don't know how it came about, but, we got into this kind of situation when we got our mortgage about a decade or so ago. It was kind of the same thing. There was the creditor option.
Yep.
And, the insurance on my wife, it's enough to cover the mortgage. It was negligible dollars per month.
Right.
And then I'm not too sure where I learned this or who I crossed paths with, but I heard this conversation and I said, this doesn't make much sense to me. I'm going to be, paying, albeit not huge dollars, but I'm going to be paying dollars into this policy for X amount of years, but my coverage is going to be depleting on this.
Yep.
It makes a lot more sense just to have a term policy that covers her for the, the value of the mortgage as it stood at that time.
Yep.
The premium was no different. And, we're a lot further ahead now than we would be had we stuck with that creditor policy. So,
Yep.
It's not like you're going out of pocket to put this type of policy into place. Like you mentioned, it's probably very
In fact, the
comparable.
opposite.
Yeah, exactly.
Yeah, the opposite. You're probably going to save money. Like you say, the premiums at the time that you did it were, pretty nominal.
Yeah.
So that tells me that you were under age 40.
Oh yeah, 100%.
Because the
Still am.
premiums would have been the same whether you bought it personally or whether you bought it corporate, whether you bought it from the creditor.
Right,
So,
right.
but once you're over 40, over 50, over 60 in some cases, believe me, you're going to see a humongous difference between the cost of creditor offered insurance versus individual insurance. A humongous difference. Like I say, I had one couple in their early 50s. And the coverage we were able to give them was 1/3 the cost of what they were paying through their bank. 1/3. So
That's a big difference.
huge difference. Had another
Sure.
couple, you know, I guess a kind way to say it is they were too short for their weight, and they couldn't get, you know, it was challenging for them to get coverage because of their build. And
Oh, okay.
you know, we were able to get coverage for them. Um, and the other aspect of that that was a little bit challenging was that he was a helicopter pilot, and there are no old helicopter pilots.
Fair
And
enough.
so the reality is, you know, not only were we able to get them coverage, but within a couple of years, I was able to get them coverage with 0 rating, like standard rates, right? Also had the same impact to the person who had sleep apnea. Everywhere she shot for insurance, she had to pay more for it. I was able to get her coverage at standard rates, right?
Interesting.
So it's a lot of advantages to dealing independently.
Right. Yeah, as opposed to checking 7 boxes, you're probably more interested in helping that family find that policy that's going to work for them. So,
Yeah, it
yeah,
seems convenient, but it ends up being more expensive and less flexible for you.
for sure. Perfect. So I think in wrapping it up, I just got one more question. You've touched
Sure.
on it a little bit, but maybe just to completely flush this out for the listeners. So aside from the insurance solutions, getting that policy to maybe match up with the mortgage or whatever the case might be, what other expert guidance are you able to kind of provide to clients that might reach out to you?
I think the expert guidance would be perspective. Through doing a financial plan and or an estate plan and or a retirement plan, I can at the very least, I can provide them a second opinion or
Hmm.
perspective, which they can then use to make decisions with. So I think that's the primary value, and we don't charge for our financial plans. They are complimentary, and here's
Hmm.
why. If I don't know what your situation is or where you are or where you're going, how can I give you a proper recommendation? So, in order for me to actually do my job as an insurance and financial planning professional, I need to have a plan to start with so that I can see where you might be exposed to any level of risk, or you may have opportunity that you're not taking advantage of or you're not even aware of. You know, I had a client recently. um, he's an ongoing client, and he's just crossed the age 50 age, and you know he's working as a sole proprietor, Jared,
Hmm.
and he provides consulting services, and he's making pretty close to 300,000. Now he has good expenses off of that. He probably, you know, after expenses, he probably nets around 180, 200.
Hmm.
He was completely unaware of the benefits of individual pension plans. And he's just now hitting the age where they can make a ton of sense for him.
Right.
But in order for him to take advantage of it, he's going to have to change from a sole proprietor to an incorporated entity in order to take advantage of that. So that's one example of how, you know, we were able to make someone aware of an opportunity that he wasn't previously aware of.
That's a great point. I think, like we touched on early, yeah, markets and rates and stuff are volatile right now, but I think with that, volatility come opportunities that
Yep.
people
Yep.
might not be
Always so
aware
much.
of. And you can only, I guess, put in a plan, whether it be, retirement, estate, based on the
Financial
knowledge
planning.
that you have. So
Yep.
if you're getting to these spots in life, and I always say, it makes more sense to plan these things out early, review them on an often basis to make sure everything's up to date.
Yep.
If you can get in and talk to Dan and get some of this planning put into place, there might be things that you're completely unaware of that could, hugely benefit you and your family if you put them into place. And if you get them done early, I always think that is hugely beneficial over the long term. So great point.
And if that isn't the case, it'll confirm that what you're doing is already good, great, and
Right,
terrific. No need to do anything else.
right, right.
So it's a valuable second opinion.
For sure. Yeah,
Yeah.
because it doesn't hurt to have that second set of eyes. And yeah, maybe you put in a plan with another, financial planner. Maybe that
Yeah.
individual's retired or moved away or something like that. it doesn't hurt to review these things. And, I know it's come up in podcast conversation that I've had recently. You got to be planning for some of those major life events, marriages, births, et cetera, et cetera. But it also
Yeah.
makes sense to review these plans every so often, just because, tax legislation changes, maybe things in the insurance environment change as well. So it makes sense
Yeah.
to review these things on a regular basis, just based on a compliance thing, something that might have been in place before is maybe offside on some tax rules now or something. So having a review every few years is going to maybe keep you from going afoul on some of these things as they change. So,
Yeah, I think as a financial planner, I tell my clientele, I'd really like to update and review your plan no less often than biannually, preferably annually, but no less often than biannually, or when any major life event occurs, it's a good idea to revisit it. It's a red flag.
for sure.
So, yeah.
Perfect. Right
Okay,
on,
cool.
Dan. Well, I think that kind of wraps up the discussion. I just wanted to say thanks for taking some time out of your busy schedule to hop on the podcast with me. If listeners want to touch base with you, what's kind of the easiest way to get a hold of you?
Probably just my phone number, 604 318 9161. Or you can just search online for the Real Mortgage Insurance Genius.
Perfect. I'll put all that information in the show notes. If you need some insurance, investment planning, any of those types of options, feel free to reach out to Dan. As he mentioned, he's licensed in a couple of provinces here as well. So, if you're outside of the BC area, you've got availability to talk to him as well. So,
yeah.
Perfect.
Thanks for having me on.
Thanks a lot, Dan. So
Okay.
for the Tax Talk podcast, I'm Jared Pallon. Thanks again for listening. Take care, and we will talk soon.
Bye-bye.